This is a webinar companion for the book Run with the Bulls, an illustrated guide to the stock market, trading strategies, and risk management for beginners. We will talk about confluences and COILs. Confluence refers to an agreement or a merging of ideas. It is the combination of multiple strategies and ideas in order to come up with one complete strategy. So when confluences exist between horizontal support and channel support lines, the trader must take notice of how price will react. For example, when the horizontal support and trend line are in confluence, then the chances of a bounce is higher and will make for a profitable trade opportunity. In this chart, we will be able to reference previous supports and resistances as current supports and resistances when trading the range. When we draw the upper and lower trend lines of the current price action, we will see that it's also trading within an ascending channel, and the pivot points or the resistance and support areas within this channel reference previous support and resistance levels. So these will be good entry and exit points for the trade. Here's another example of how we use moving averages as well as ascending channel supports and resistances in order to find entry and exit points within the trade. In this chart, we see that price was on a downtrend. It was inside a descending channel. When price made the bullish reversal to the upside, it created an ascending channel, while the price also broke above the moving average lines. So we will be able to confirm breakouts through confluences of moving averages and channel lines. But in point 13 and 14, we see that price also broke below both the moving average and the ascending channel support line. Therefore, we have a breakout failure. The confluence between the moving average line and the channel support line is one of the best setups to go long in an ascending channel. Seek out high probability setups such as these to increase the chance of a winning trade. In this illustration, we see that price is at the 50 EMA line. It is also at the support of the ascending channel. So we go long because as a confluence between the moving average line and the channel support line increases the probability of a bounce. This, coupled with a bullish candlestick with a higher low, is a confirmation of a buy from that confluence of supports. So medium-term traders will use confluences as stop loss when going long. This illustration shows a descending channel with a high probability of a rejection from the channel resistance because the 50 EMA line and the channel resistance line are both located at the same area. So there's a confluence between the moving average and the channel resistance line, which increases the probability of a price rejection. Coupled with that, there's also a bearish candlestick with a lower high that signals a short position. So we use the same strategy for horizontal channels. If we see that price is at the 50 EMA line and at the horizontal support line at the same time, we go long. The confluence of moving averages and the channel support and the bullish candlestick at this support area increases the probability of a bounce. In this example, if there's a confluence between the moving average, channel resistance, and the bearish candlestick at the horizontal resistance line, then you can go on a short position or take profits on a long position. COILs can form in a variety of chart patterns. In this example, we see price consolidating at the highs in a horizontal channel that resulted in a bullish breakout. In this next example, we see that price is consolidating within an ascending triangle, which is a bullish pattern. When price broke above that, it created a coil above the ascending triangle pattern. Here's an example of a breakout above an ascending triangle pattern where a coil formed right on top of the ascending triangle before continuing on its uptrend. In this illustration, we see that price has been on an uptrend. Price then consolidated sideways within a trading range. Price retested the previous resistance as the new support by creating a short-term consolidation pattern above the breakout point. This pattern is called a COIL. It suppresses price, creating enough energy to push the price in the direction of the breakout once the coil is released. When the price broke above the coil, it made higher highs above the breakout point, resulting in a continuation of the uptrend. Now here's an example of a trend continuation. After price broke above the consolidation range, it formed a coil on top of the pattern or the box pattern and then continued to make higher highs and continued on its uptrend. Another example of coil forming near the resistance point. So there's a consolidation at the highs. This consolidation at the highs shows the strength of the bulls who are keeping the price at the higher range of the box that resulted in a bullish breakout and a continuation of the uptrend. Illustration shows how the coil is formed above the resistance area, and this shows the strength of a bulls in a bullish breakout. This example, price is on a downtrend. Price tried to break above the resistance line, but it failed to break above the box, and then it formed a coil pattern below the box and continued to make lower lows and continued towards its downtrend. This example shows coil forming below the channel support line, which shows a bearish breakout, and it also shows the strength of the bears who are keeping the price below the resistance line. Consolidation at the lows is an indication of the strength of the bears. Here's an example of a series of coils forming within a downtrend that caused prices to move further downward after a break below the coil. This example, price consolidated at the lows of a horizontal pattern that resulted in a bearish breakout. In this next example, price consolidated at the lows of a descending triangle pattern that also caused a bearish breakout. Time there is a breakout, observe where price consolidates. If it consolidates above the breakout point in a bullish breakout, then there's likely to be a continuation of the uptrend or the breakout to the upside. If price continues to consolidate below the breakout point in a bearish breakout, then the downtrend is likely to continue.